The reason most people don't meet their financial objectives is because they get distracted. They don't have the discipline to do it. You have to be so disciplined. It's hard in this day and age where all you have to do is pick up your phone, get on social media, and before you know it, you've forgotten what you were even doing. Hi, I'm Annette Ba'u, host of the Wealth Inside and Out podcast and founder of the Millionaire Insider. My mission is to help you simplify the money game so you can create a financially secure and fulfilled life without having to have a PhD or spend countless hours on your finances. You're going to learn how to think like a millionaire, stop worrying about money and wondering if your financial house is truly in order, and instead spend your time doing what you love. With over 3 decades advising 7, 8, and even 9-figure millionaires, and now joining that elite group, I'm in a unique position to help you make the best financial choices so you can create a secure financial future and retirement you love. This is the Wealth Inside and Out podcast. Today's free resource is our financial freedom guide. You can go to themillionaireinsider.com/FFG. Insurance is one piece of a properly designed financial plan, and this guide is going to provide you the big picture so you can create a plan that works for you and your family and helps you create a financially secure life so you can spend your time as you choose. You can get the guide at themillionaireinsider.com/FFG. For today's show notes, you can go to themillionaireinsider.com/105. All materials on intellectual property are copywritten by themillionaireseries.com. This information is for educational purposes only. It is not intended to replace any advisor or specialist or to provide any investment, financial, tax, retirement, planning, or healthcare advice. All participants agree to hold millionaireseries.com and its affiliates harmless for results achieved or not achieved, and all international copyrights are reserved. So let's dive into before you buy term and invest the difference. Today, you're going to learn the understanding of the different types of insurance so you can make the best, most informed financial decision. You're going to learn the philosophy behind buy term and invest the difference. And you're going to learn 3 insights that can save you money and help you grow your retirement funds. The most important insight, and this is critical, is to purchase the coverage you need and can afford. Too often in my career, I've seen somebody who needs $2 million worth of coverage and really should be in a term product and instead has purchased a $500,000 whole life policy because they've been sold on the concept of if they don't need it for life insurance, they can use it for retirement. Now, I love using products for 2 reasons, as long as you have the right coverage. If you don't have the right coverage, then there's no point in doing it, because the whole reason you have life insurance first and foremost is because you have a need in the event that one of the parties dies and prematurely and needs the coverage to replace income. So make sure you have the right coverage. That is hands down the most important decision you can make. So let's look at the different types of insurance coverage. Term coverage is just basically pure coverage. It's low cost, it's temporary. If you need insurance, generally speaking, for 7 to 10 years, this is possibly your best option. If you need it longer and you don't have longer-term coverage, like say 20 or 30-year term, you could have a problem, because what typically happens is you either have to reapply for insurance, so you have to be insurable, and it's going to obviously be more expensive because you're older, or you're going to have a very expensive option to convert it to. Now, what I have seen in my career is the cheaper the cost of the term, the more expensive the policy you can convert to, and the more strict the rules. Term coverage is more like renting. You pay for a period of time, but at the end, you have no equity, kind of like a rental versus a home you own. So just be aware of that. Recently, we've had a case where the person had a 20-year term. The cost to keep the term was 10 times what they were paying for the term. So it's just cost prohibitive. And they missed the window to convert the policy, which had to be 2 years before the expiration of that policy. And so the company at that time, had they not missed that opportunity, only gave them 2 options. One was a very expensive whole life, and the other was a UL that was expensive, but it was like term coverage. So again, you got to be really careful. If you're buying term, you got to make sure you understand that if you're getting a really cheap one, you're getting what you pay for. And the insurance company is betting on the fact that either you're not going to need it, or if you do, then you're going to have to get into a more expensive product. So plan accordingly. Now, permanent insurances include whole life, universal life, variable universal life, indexed UL, as well as different hybrids. I want to give you a brief overview of these just so you understand them. So whole life is a traditional form of permanent life insurance with guaranteed features. It typically has level premiums, meaning you can pay the same amount for life. It has a guaranteed death benefit that's fixed and guaranteed. It's got guaranteed cash value that builds up at a fixed interest rate over time and oftentimes has dividends. Some policies from mutual insurers pay dividends, which can be used to buy more coverage, reduce premiums, or even take cash out. So some of the pros are it's predictable and stable. You have guarantees in place, and it's great for conservative people. The cons are it's more expensive than term and really even universal life, and it's less flexible than other permanent policies, meaning you've got to pay that premium unless you have enough money built up to pay it. All right, universal life is probably more common, I would guess. It's a more flexible form of permanent life insurance as compared to whole life. You've got flexible premiums, which you can adjust, increase or decrease. And again, you've got to look at the policy to make sure that you can do it. You have enough money in there to do that, but it is flexible. You can have an adjustable death benefit that may increase or decrease. And your cash value growth earns interest based on current rates that are set by the insurer, and it's not guaranteed beyond a minimum. So you got to be really careful of that and make sure you're using a company that has very high integrity. Pros are it's flexible in premiums and coverage, and it can be structured for cash value growth or just pure death benefit. So it's got a lot of flexibility. The cons are that the cash value growth is interest rate dependent, and it's less predictable than, say, a product like whole life. The third type, variable universal life, combines flexibility with investment options. And some of the key features of that are a flexible premium and a death benefit similar to universal life. But the cash value is invested in sub-accounts like mutual funds that give you market exposure. So there's a lot more potential for high growth, but also greater risk. Some of the pros, one is investment potential, but you remember you've got upside and downside. Control over the cash value that you and where you invest it, and then tax-deferred growth. Some of the negatives is there's no guarantees on the cash value. Market losses can reduce the policy or require you to pay more. It requires very active management and a higher risk tolerance. Now, my husband and I personally have a policy like this, and it's not something I would ever recommend an average person to get because you have to really have an ability to handle a lot of volatility. And if you go through a down period for an extended period of time, you're going to have to come up with a lot more money. Now, it's worked out very well for us, but it's not something I would recommend unless you've got a lot of money and you can handle a lot of volatility. It's just typically not something I like to see in an insurance policy. And I don't even know why we got it. I think we got it because I think some company offered like a no load, and it was just a great it was a great option. And it's been a good investment, but it's just not something I'd recommend for somebody that needs life insurance. Now, that said, we also have universal life and we also have term. So we have pretty much the whole gamut. The only thing we don't have is whole life. All right, index universal life. This is a UL policy where the cash value is tied to the stock market, commonly the S&P, but it has limits. So it's flexible as far as its premium and death benefit. The cash value is linked to a market index with a cap, meaning a maximum interest and a floor. And this is the key with an index universal life is that you can't typically lose money. Now, had this been available when I purchased my policy way back when, I would have chose this over a variable UL. There's no direct investment in the stock market. There is tax-deferred growth potential. And then some of the pros is you have upside market potential without downside risk. You've got flexibility, and it's often used in retirement planning for tax-advantaged income. Now, I am going to make a comment on this. I personally do not like using life insurance policies where you're planning on taking money out of them. If they change the tax law, you are going to have a problem. You're going to have a taxable event. If you end up using your life insurance for retirement, you can roll it tax-free into an annuity and then take income that way. I prefer that over taking money directly from your policy unless you don't have other options. You always want to be using a fiduciary so they can look at the different options and give you insight on the best option for you. And then some of the negatives are returns are capped. So if the market does really well, you won't do as well. It can be a little more complex to understand. So for some people, that can be overwhelming. And the performance depends on how the index performs and how the insurer structures the cap or the floor. So again, you've got to read the fine detail. You have to be working with somebody who knows what they're doing. And then, as I mentioned, there are hybrid policies where you have different options combining long-term care or retirement benefits along with life insurance. And I like those if it's applicable. So again, just look at what you need, your situation, and then you can make the best choice for you and your family. So now let's talk about reality versus theory of buy term and invest the difference. The concept behind buy term and invest the difference is that term insurance is cheaper. So because it's cheaper, you're going to have more money to invest. And the concept is your investments grow and ultimately that account grows enough to where you don't need your insurance. And so on paper, it really does sound logical and it sounds great. That said, in reality, most people never invest the difference. I have seen this so many times. Life happens. What happens? Expenses come up. People forget or they delay starting that investment plan. The reason most people don't meet their financial objectives is because they get distracted. They don't have the discipline to do it. You have to be so disciplined. It's hard in this day and age where all you have to do is pick up your phone, get on social media, and before you know it, you've forgotten what you were even doing and you've wasted an hour of your time. The issue is that term runs out. When you're older and possibly uninsurable, you're going to pay a lot more money for your policy. Cheapest isn't always the best. You get what you pay for. And as I mentioned earlier, I've seen so many policies that were really cheap getting into, and a person thought, oh, this is great. I'm only paying this much money, but they forget to ask all the questions, such as, can I convert this? What type of policies can I convert it to? Let me see a sample of one of those policies I can convert it to. When they're super duper expensive, that's how they're making up for these term policies. So you got to realize there is no free lunch, my friends. As I mentioned earlier, and I just want to recap on, you got to know the reason for your coverage. Is it to replace income in case of a death? Is it legacy planning? Or do you want to plan for long-term care and combine the policy, the life policy, with a potential need for long-term care? Is it to protect retirement income for your spouse? Now, this is really, really important. Something I wish I would have known when I first started planning. When the first spouse dies, you're going to lose the lowest Social Security check. I can't tell you how many clients I have seen over the course of my career. Thank goodness I discovered this not too long after I began. But how many did not plan for this? And what happens is you've lost 50% of your Social Security in many cases. Sometimes it's 25%, 30%, but you've lost a significant amount. But your cost of living does not go down as much as you've lost. And so what ends up happening is the surviving spouse struggles. This is another reason why you really should consider a more permanent product if that is a potential problem for you and your family. One of the other reasons it's really important as far as your coverage is to plan for your retirement. Not just your working years when you need to replace your income, but what about making sure that your partner has additional resources as the cost of living increases? They now have less money because they've lost Social Security. If you are one of those people that has a pension that's gone away, also that can be a problem. So those are just some reasons you need to get really clear on when you determine your coverage. Flexibility, in my opinion, is probably the most important aspect. Life changes, and so should your insurance policy. You may need life insurance now, disability insurance later, long-term care, or even retirement income. You've got to have flexibility in whatever you do. Hybrid plans offer multiple layers of protection, which can be ideal. You want to always work with a fiduciary. They have to look at your situation and make the best recommendation for you. They can't make the best recommendation for what will put more money in their pocket or the company's pocket. So always work with a fiduciary. Having a plan in case A happens or B or C gives you more peace of mind and it gives you more flexibility. And it's much better than a one size fits all policy. And so just be aware of those things because too often people aren't. And then they wind up in a situation where they don't have the options or the flexibility to meet their current situation and what has occurred in their family. All right, some common pitfalls to avoid. Buying the cheapest term without considering the long term implications or understanding what that means long term, meaning how much we have to pay, how much does the insurance go up. All of those different factors are going to be huge and should be taken into account when you purchase insurance. What happens if you become uninsurable later in life or you get rated? As you get older, you have health issues and they're getting more and more strict. They're not getting more lenient. And so you got to be really clear on what your plan is now, what your plan will be in the future. And if you become uninsurable, what are your options? You want to make sure you have a plan that can work with you and your situation. Underfunding a policy that needs to last longer. What I find a lot of times happens is people aren't properly funding, say, their universal life policy. If you've got a universal life or a variable universal life or even an index universal life, you've got to look at that from a perspective of how is it performing and do you need to put more money in or less money in? Now, I like to solve the policy to like 105 or 120, and 120 is probably too conservative. So let's just say it's 105. Most policies are like 92. One we recently did was 92 or 105. Well, we just did 105 because I didn't want to risk. They could easily live. I've had several clients live past 92. So you just got to be aware of that. And I remember early in my career, I had a woman I was referred to by a big trust company. And this woman had not been properly funding her insurance. And it was devastating because had she been funding it more all along, she would have been fine, but she hadn't. And now she had a premium of over 6 figures due. And she was absolutely mortified. She was in her late 90s and she didn't know what to do. And I remember thinking, well, now's not a good time to wonder what to do. You should have been funding it as you go. But unfortunately, her insurance agent never followed up with her, never did an in-force illustration. An in-force illustration is what you request from the company to determine what's going to happen in the policy, what has happened to this point and what's going to happen based on projected numbers. And you always want to keep looking at that. We recommend every other year when a person's younger, unless it's like, say, a variable policy, then you can do it every year. But what we do on our older clients is we look at that every single year to make sure they're funding it enough, make sure there's no surprises, that we know what's going on and we know the coverage is going to be there when they need it. When you underfund a policy, you are just begging for problems in the future. The other thing you have to be really careful of is that you don't get locked into a product that doesn't meet your ongoing or evolving needs. So just some considerations. So there you have it. So let's recap. The first thing is you got to understand that when you're buying insurance, especially buying term, investing the difference, something that sounds really good on paper may not play out in real life. If you're doing a concept based on taking actions and you only take half the action and buy the term and you don't invest the difference, it doesn't work. So you got to make sure that you're going to do that. Most of the people that would buy term and invest the difference typically are people who don't have a lot of money. And this can be a great option for their retirement where they have money to be able to use it for retirement if they don't need it for a premature death. You got to know why you're buying the coverage. Is it just to rent it or is it to own it? And again, you got to understand that. You want to build flexibility for the unknown. The one thing we know about life is that there is a lot of uncertainty and there are a lot of unknowns. And part of that's the beauty, the excitement of it. But the other part of it is we got to make sure that our plan also meets us wherever we are. And that's what a good plan can do. Again, I encourage you to work with a qualified fiduciary and make sure that whoever you are working with has your best interest at hand, that you're getting the amount of coverage you need versus getting a much more expensive product that doesn't give you the death benefit coverage you need or your family needs in the event that something were to happen to you. Now, if you have questions or want to consult with an advisor, you can go to themillionaireinsider.com/SR. I want to thank you so much for joining me. I know this was a little different, but it's something I see happen so often. And recently, I have seen so many different situations Not so much when a person was buying term and investing the difference, but where a person was buying term and they didn't realize that this cheap term product really is not going to solve their problems. And now they have fast forwarded to the end of the term and they have a problem on their hands. So don't let that be you. Take time to get your plan in place and make sure you have the right coverage and create flexibility into your plan. You're going to be a lot better off. All right, I'll look so forward to seeing you on our next episode. If you love the content of this podcast, please follow and subscribe to our channel so you get notified of episodes, and also give us a 5-star review and share a comment. We really appreciate it. Congratulations on taking another step to create a financially free life you love. If you're not sure about your financial future or that it's in order, or you are ready to stop worrying about money, or possibly the fear of becoming a bag lady, ending up broke in retirement, or you simply are ready to know your financial house is in order so that you can have a bright financial future, please go to themillionaireinsider.com/NSF. And that doesn't stand for non-sufficient funds. It stands for Next Step Finance. It's the next best step of what you need to do so you can avoid an NSF notice in your future. Again, themillionaireinsider.com/NSF. The number of women who were not broke or poor while working or married is staggering. The entire mission of the Wealth Inside and Out podcast is to ensure you have the information for you, your family, your friends, anyone who's willing to listen to it and apply it so that you can create a financially free life you love. Again, themillionaireinsider.com/NSF. Until our next episode, take one action that will help you create a financially free life you love. I'm Annette Ba'u, your host. All international copyrights are reserved. Bye for now.